ask you about your perspective on risk at the moment. I know that you think that the big risk at the moment is, we spend a lot of time thinking about the geopolitics, whether that's the Korean Peninsula or the Middle East, the Iran deal, and yet you remind us that perhaps the big risk to markets right now is inflation, and inflation coming in stronger than the markets had anticipated.
Absolutely. So the immediate market reaction to the exit of US from the Irans deal has been a rally in oil prices and a weaker dollar. This has benefited US equities, especially in the energy sector, and has calmed down the emerging markets. But the most lasting effect will be probably driving more volatility in the oil markets because of rising tensions between OPEC members, and that will be complicated for market to anticipate any kind of upward trend in oil. So the volatility in oil prices will probably translate into more volatility in inflation expectations.
Yeah, Morgan, as you say that, I want to just show you this chart, which kind of points to exactly what you've said, with volatility in oil edging up as WTI has been trading above $70 a barrel. And then you've got Bank of America Merrill Lynch actually saying that $100 Brent is in play. So is volatility in inflation more of a concern, or the actual level of inflation?
From an investor point of view, what's important is it's what level of inflation will actually endanger the current path of the future interest rates currently priced in the market. So any unexpected rise of inflation would make a more difficult task for central bankers, the Fed, but also other central bankers, to anchor inflation and interest rate expectations.
And of course, one of the interesting dynamics around the inflation story in the United States and the Fed tightening. Last year we talked about, why is the dollar not strengthening as the Fed tightens? And this year things changed and the dollar did start to strengthen, and we saw what that did to emerging markets. Are you concerned about emerging markets? I've got this map that shows IMF estimates of FX reserves that emerging markets need to have to enable them to weather the storm, if you like, of a stronger dollar. And it flags up some of the usual suspects as risk areas, the likes of Argentina, Malaysia, interestingly, but Russia looking more stable on this particular measure. Are you concerned about emerging markets and their ability to withstand the Fed as it hikes?
So if we look at ETF flows, for instance, they have been declining slightly. There were some outflows from emerging market equity ETFs in the past couple of weeks, mostly in reaction to a decrease in emerging markets. But now, looking at more bigger picture and looking at what happened since the beginning of the year, emerging market has been quite resistant to market turbulences. And the main reason is that there are some better fundamentals that is providing a solid ground for emerging markets, but also they're still enjoying a very strong global demand, no hard landing in China. And now with the rise of oil prices, a weaker dollar will benefit emerging markets. So as long as the interest rates are rising only gradually in the developed world and the dollar remain quite low, this is quite stable outlook for emerging markets, in my opinion.
Right, as long as the dollar remains low. Of course, people are split on where that's going to go. But I just want to get your ETF perspective on this, Morgan, because this chart shows basically the sort of record short positions that we've got at the moment in 5- and 10-year Treasury futures. Now, the last time that happened at the beginning of last year, as I'm sure you're aware, yields actually then ended up coming down, as we saw those shorts being covered. That hasn't happened yet, and we've been fairly range-bound on the 10-year Treasury yield for the past few days. Are you seeing anything in ETF flows that tells you the direction of where we could go on the 10-year Treasury yield?
Well, not exactly, because ETF trends are very short-term, and it won't be it's not easy to read too much into it. But for the long-term, long end of the curve in the US Treasuries is obviously influenced by inflation expectations. So again, coming back to inflation expectations, I think this is key for markets and the economy this year.